All right. So one of the major things, one of the major keys for success in trading is understanding risk and money management. I'm sure many times we've heard of people who have they have a negative um, they have a negative perception of investing, of the forex market, of the stock market, especially the forex market, because a lot of people have used the forex market for scams, over the years, right? But one of the reasons why you hear someone say, "Oh, I lost a lot of money in the market. I lost 2 million in the market. I lost whatever amount of money in the forex market," is because of a fundamental misunderstanding or a fundamental lack of understanding. It's better. A fundamental lack of understanding of the risk and money management, the risk and money management framework, the risk and money management thinking when it comes to the forex market, right? Now, this risk and money management is so important that no matter how skilled you are with all the strategies that we're going to be learning in the future, no matter how skilled and good you are with those strategies, you will still manage to lose money. You will still manage to lose money if you don't understand risk and money management. Okay, so that even when it comes to the VC world, when I say VC, I mean venture capital. These guys are investing in tech, right? They invest in tech startups and all that. They have a strong risk and money management system that they use to win and succeed on a very consistent basis. And one major thing you hear, if you have any idea about how that world works, the risk and money and the venture capital world works, is they always think in terms of probabilities. So what they would do is that for example, they have a certain amount, let's say $100,000, right? And then they want to invest that $100,000. What they will usually do is that they will spread that $100,000 across probably 20 different investments. 20 different investments. And their goal is this. They know that of those 20 investments, probably 70% of them will not, of that investment will yield nothing. That's the way they think about it, right? You can do a little study on this. You see that that's what it is. Their thinking is that more than probably 70% or more of those investments will yield nothing. And then the remaining 20% 20 to 30% or so will give them out 10, 20, 100 times their investments. So they put 5,000, they have $100,000, they put 5,000 into 20 different investments. They believe that one of those investments will make them 100x. And like 70 to 80% of those investments will go to zero. But one or two will give them 100x. That's the way they think about it, right? And the reason why they do that is because they know that it's real life and those things happen. But when it comes to trading, usually as traders, most times we don't, especially traders who are just coming into trading, we don't think like this. But this is the right way to think about any kind of investment, because investments they will perform differently, right? You never can know which one is going to hit a home run. You never can know which one is going to do very well and this one that's going to do the worst. You never know. You may look at whatever you want to look at, but how it's going to perform, it may be different from the way you perceived it or the way you thought about it. Just recently, a few days ago, we've been hearing of this company called NVIDIA. NVIDIA, they produce chips and all that, GPU cards that are used for gaming and all that. They produce those things, and that company right now has become, I think, the number 5 company in the US to hit $1 trillion mark, $1 trillion market capitalization. But that's a company that most people have never heard about. That company was not in the class of Google, Apple, and the rest of them many years ago. Some people invested in it and just left their investment there, and the thing has turned to something big. And there were other businesses, other investments that other people thought, oh, we are going to do much better, and they didn't do much better. So do very well. So that's the way it comes when it comes to trading, forex trading, and all that. So you always have to first of all think, how much money do I have? Now, this outline, this short outline I wrote here is not in any particular order. I will just pick different things and explain them. So you always have to think, how much do I have and how much am I allocating per trade? How much am I allocating per trade? Because you understand that, see, you can enter a trade and the trade will go bad. That's it. So, but the goal of our trading is that we want to be able to win more than we lose. We want to be able to win 70%, 80%, or 60% of our trades. And then we use money management, risk per trade to maximize our gains. You see, to maximize our gains. That's what it is. Now, it's possible for you to win. It's possible for you to be a trader and you win 50%. You win 50% of the time, or even less than 50% of the time, and you are still very profitable. So what that means is that, let's say you take 10 trades, and then you're using a particular strategy or a particular approach, you take 10 trades. You can even lose 6 and win only 4, and then you are still overall profitable. You are making a lot of money still with 40% win rate. It's about money and risk management. Now, imagine if you're not having a 70% win rate. If you now have a 70% win rate, what that means is that you are going to you're literally going to be multiplying money. That's what it is. You see? So that's why this risk and money management is so important. Number one, we'll start with risk per trade. Risk per trade. So risk per trade has to do with how much am I allocating to a trade? How much am I allocating to a particular trade I want to take? Let's say I'm taking a trade for Euro USD, right? Let's say I'm taking a Euro USD trade. Let's say I'm taking a Euro USD trade, Euro USD. That's the trade I'm taking. Let me close this out for now. So let's say I'm taking a Euro USD trade, right? How much am I allocating to this trade? Risk per trade is how much you allocate to a trade. How much you allocate to a trade? Let's say 3%, right? So you are allocating 3% of your money. Let's say your capital here, you're trading Euro USD, your capital, which you have in your account, your capital which you have in your account is $1,000, right? $1,000 is the capital you have in your account, and you are allocating 3%. 3% will give you $30. 3% will give you $30. That's how much you are putting on each trade. So what that means is that if you are allocating 3% to a trade, you know that you can do that 30 times on your capital. So this way you are protecting your capital first. This is very important. So you determine that, okay, I'm going to risk 2 to 3%. It is advisable that you risk 2 to 3% of your capital on a trade. 2 to 3%. 2 to 3% of your capital on a trade, right? If you have like $100, this could be a little higher, right? If you have like $100, this could be a little higher. It could be 2 to 5%. 2 to 5% is still okay for a $100 account. 2 to 5%, right? But 2 to 3% is ideal. But 2 to 5% is still okay if you have a small account. If you have a much larger account, you might even reduce this 2 to 3%. You might even reduce it to even less than that. Okay? There are people who are trading with between 0.5 and 2% on their account because they are trading $100,000 account, right? So the more the capital you have, the less risk you should be taking on it, right? So that's the first thing. So you think about it, like I was talking about the venture capital, how they allocate their money. They can allocate 5% to every investment they want to do, right? So that's the way also as a trader you have to think. Think about allocating that little 2 to 3% of your account on a trade, to a trade, right? So that's the first thing you do. Then the next thing you want to do is this. For every trade, you have to think about your stop loss. Now, I know that we already can see that the trades we take, we usually will have stop loss on them. But sometimes we may not understand, especially if you are new, you may not understand what is stop loss, what is stop loss used for, what's the purpose of stop loss. Now, the purpose of the stop loss is to help protect your account, So why is that important? Now, when you want to raise 2 to 3% of your account, there are people who've funded, they created account, right? And they funded account with $100 and they took one trade, just one trade. And that one trade went negative. That one trade went negative, which means it went against them and their whole $100 was gone. Their whole capital was gone. There are people who have done that for $1,000. There are people who have done that for $10,000. There are people who have done it for even more than that. Somebody was telling me that day of a guy who was trading and he lost $100,000 trading, right? So now, usually people who lose big money like that, they always find a way to bounce back and come back into the market. But then you don't have to make that huge loss to be able to learn your lessons. And the reason why somebody is making a huge loss, somebody can make a huge loss, is because they didn't learn the basics when they didn't learn the basics at the beginning. So they didn't learn the basics at the beginning, so that's why they made the huge losses. So you don't have to make that. So you always need to think about, number one, what is my risk per trade? Okay, I'm risking 2 to 3% on my account, which means on a $1,000 account, I'm risking $20 to $30 on a particular trade, right? That's what I'm risking, $20 to $30 on a particular trade. So I always need, after I think about my risk per trade, the next thing I want to think about is my stop loss. What is my stop loss? So if I have to understand that, see, as a trader, you always must think in terms of risk first. As a trader, you always must think in terms of risk first. So you're not thinking of profits first. You think of risk first. That's the way you think if you are going to win as a trader. Now, I know it's counterintuitive for most of us. It's counterintuitive for most of us. When you want to start a business, you are thinking of making money first. In fact, you are starting a business to make money. Yes, you are also trading to make money, correct? But then when it comes to trading, the way to win is that there are certain things when it comes to trading, certain mindsets that we have to adopt because of the uniqueness of the industry, the uniqueness of this business, right? The uniqueness of this business. There are certain thinkings we have to drop, and there are certain mindsets that we have to adopt because of the uniqueness, like I said, of this particular business. And one of it is that you have to think in terms of risk first. And the reason why that is important is because that risk that you are not, if you don't think about risk, the chances are that you will do things that would lead you to a very huge loss is high. And when we say risk here, we are talking about loss. So you must think in terms of loss first. So you have to then think, imagine that sometimes you see on the road and you see certain guys driving motorcycles, right? Like a bike. And then they go in between very huge vehicles and they move like as though there is no possibility that something bad can happen to them. And that's usually the reason why you find out that those kinds of people, they are usually the ones that those catastrophes happen to, because they were not thinking like that. They were only thinking, I need to get to where I'm going. They don't care about what risks they could face because they've not seen it before. It hasn't happened to them. They don't think of what could happen if I just try to maneuver and then it doesn't go the way I want. They don't think like that. But when it happens, it becomes dangerous. It becomes such a catastrophe because they were not thinking about it. Meanwhile, the other person who was riding carefully so as not to, get into a bad situation, That one, even if something happens, he still has a way of, you know, bouncing back, because maybe he has a helmet. He's prepared for, in case of something like this. It's not because in case of an accident of some sort, right? So not because he plans for it, but he prepares himself to mitigate anything like that, right? I know in Africa people say, "Oh, God forbid, oh, it's not my portion," you know. But it's not about portion. It's about just having the right thinking. Therefore, you prepare for it. Therefore, you are ready. Not like you prepare for it. You know, you don't expect it to happen, but you guard yourself, as it were. You protect yourself. You do the right thing, you know, so that you don't get into a situation that is not that's not what you want. So that's the thing. That's the same thing with trading. So in trading, you want to think about loss first, so that you don't lose what you are not plan, what you didn't plan to lose. Right? So when you think about trading and you're thinking, okay, I want to take 2 to 3% risk on my trade, then you know that if a trade goes against you, there is something called stop loss. And that stop loss means that if the market starts to go against me, is basically a predetermined point in the market, beyond which you are not willing to take a loss. Okay? A predetermined point in the market beyond which you are not willing to take a loss. So let me give an instance right now, right? Let's say these are two different points right here. These are two different areas right here, right? So now you are entering for a buy, right? You're on this particular trade, hypothetical trade, you are entering a buy trade, right? You're entering a buy, and then this is the point where you are entering the buy at this area now. This is the area for your buy. You're entering a buy here and you're expecting price to go up, right? But then once you enter a buy here, price starts to come down. So you want to think about it like, okay, even if price starts coming down, you know that there's a possibility that as it comes down, it's going to bounce up again and start doing exactly what you plan. But you know that it is possible that you are just wrong on that trade. And then if you enter the trade here, you may just plan to buy and the thing starts to sell massively. You cannot let it continue to sell and sell and sell and sell and sell infinitely. You don't have enough capital to weather that kind of storm in the market. So what you want to do is that you want to tell yourself that, okay, if price moves, if I enter here for a buy, I expect it to buy. But in the case that it doesn't buy and it starts to come down, it shouldn't go beyond this place. If it comes to this point, I close me out of that trade. It means that I'm wrong. I'm out of that trade. That's the meaning of stop loss. And that has to be in every trade. And that is actually a factor when it comes to maintaining your risk per trade. You set your risk per trade and you said, okay, I'm going to take 2 to 3% risk on my trade, right? So now this stop loss, if you don't apply a stop loss, you will not be able to achieve that goal of 2 to 3% on your account of loss. You won't be able to achieve it. Now I'm talking about loss first. If someone says, why are you here talking about loss? We are talking about profit, you're talking loss. Yes, as a trader, you must think in terms of risk first. Otherwise, you will have issues in the market. You will come one day and say the market does not work, forex market doesn't work. Forex market they took my money. I lost millions because you were not thinking of risk. You were not thinking of risk, you were only thinking about reward. And the market is risk to reward. Yes, you must think, when you think about risk, then you mitigate the risk. You make a plan to mitigate the risk, then you move into the realm of reward now. That's the way it works. You move into the realm of reward because you've already taken care of the risk. You've taken care of the risk, right? So the next thing you want to do is take profit. Take profit is the next thing here. Take profit is our reward. Take profit. So we'll go through this quickly. We'll look at the market to see if we have a trade we can take. So take profit is our reward. Stop loss is our risk. Stop loss is our risk. Take profit is our reward. Take profit is our reward, right? So we are risking to make a reward. Even though we are thinking of risk first, that doesn't mean we are not conscious of our reward. We are conscious of our reward. We just want to make sure that we cover our tracks well. We just want to make sure we mitigate catastrophic loss, right? Catastrophic loss is the kind of loss that loses you most of your capital or everything of your, or all of your capital. That's what we call catastrophic loss. Now, if you avoid catastrophic loss, then that's when you can maximize your reward in the market, right? You can make a losing trade. You can make a losing trade. You can make a losing trade, and the trade is like $5. You lose $5 on your account, right? You lose $5. Then you enter another trade, you make $10. Now you have recovered your $5 and made $5 profits. That is exactly how trading works. That's exactly how trading works, right? So, but if you do not take note of if you don't take into cognizance that there's a possibility of a loss, that $5 loss that you took could be $50, which means that it could even be 50, it could be 100. You could lose all your money on that trade. But meanwhile, the next trade that is coming is going to give you profit. But because you never waited, you didn't manage your risk well, manage your money well, to wait for that next trade that will make you the profit you're going for, you will not make the profit that you're going for. You see? Very important. So take profit as our reward. So as we set our point in the market where we think that if the market goes against us, we need to cut our trades and take that loss. We also need to target where are we looking to make profits? Where is once this trade goes in my favor, I'm entering this trade at this point, right? If this trade goes in my favor, how much profit do I want to take? How much profit do I want to take? That's the meaning of take profit. That's the reason why we use it. What is the reward on this trade? Because for every trade you are taking a risk. But you cannot be risking when there's no possibility of reward. It doesn't make sense. So there's what's called calculated risk. So calculated risk is risk that, number one, the risk is not going to destroy you. That's number one. Number two, there is a potentially huge reward. A reward that is potentially larger than the risk. That's when the risk makes sense. If the reward is larger than the risk, then the risk begins to make sense. If the reward is equal to the risk, it's not bad, it's not good, it's neutral. Okay? Most of the time, you won't want to do a business where the risk and the reward are the same. You want the risk to be lower than the reward. You want the reward to be really much, much, much larger than the risk. So that's the way it is in the market as well, right? Now we come to what we call risk to reward ratio. So the risk to reward ratio is what I was just explaining now. The risk to reward ratio is what I was just explaining now. And that risk to reward ratio has to do with what is the percentage of your risk that is your reward? What percentage of your risk equals to your reward? So let's say you are risking, let's say your risk is $10. Let's say your risk is $10, right? Let's say your risk is $10. What should your reward be? What should your reward be? Your reward has to be at least 2 times of your risk, twice your risk, 2x risk, 2x risk, which is equal to $20. So your reward should be at least 2 times your risk. That's when it starts to make sense. If it doesn't make sense, if you don't do that, then it's not really think about it, whatever business you want to do. If you know that you are only going to make back the money that you put inside, it's not very exciting. It's not really very exciting. It's not life-changing. So there's no real goal. There's no really drive. There's no real drive, no real excitement behind it, because you already know what you are going to make is basically going to be equal to your capital. Since it's equal to your capital, it's not very exciting. But imagine that risk that you're going to take is 10 times your risk, is 20 times your risk. Now you are getting into the realm of dreams. You are getting into the realm of dreams. Let's say you are putting 1 million into something and you know that you can make 200 million in profits from that. Now you can start thinking, okay, now I'm going to buy a house. Now I'm going to do this. Now you start dreaming. Remember, every business has challenges. It is those dreams and the possibility of that huge reward, huge return, huge reward is what gets you through the challenges, because you're going to have to fight against things. You're going to have to be under pressure. You are going to have to weather the storm and all of those things going through into that business. But when you know that the risk, the reward is very high, it makes it easier, it makes it easier for you to take the risk, bear the risk, as it were. So that's what it is. So the way this is done in the market, in the forex market, is this. Whenever your risk, your stop loss, let's say your stop loss, let me push this here. So let's say your stop loss, is 300 points. Okay, let's say your stop loss is 200 points. Let's say your stop loss is 200 points, right? Your stop loss is 200 points. Your take profit has to be at least 400 points or more. Has to be like 400 points or more. Okay. Now, there are times where in the market you can actually get risk to reward ratio of 1 to 10. Your risk is 1, your risk is $10, for example, and your reward is like $100. So this risk to reward, now, if your stop loss is 200 points, your take profit should be like more than that, 400 points or more. It could be 1,000 points. It could be 1 to 2. So this risk to reward ratio is what we call 1 to 2. 1 to 2. This is the risk, 1 to 2. 1 to 2. This is the risk to reward ratio, 1 to 2. Your risk is 1, your reward is 2. So your risk is $10, your reward is $20. Your risk is $10, your reward is $20. That's what we call 1 to 2. There are times where you can have 1 to 3, right? You can have 1 to 5. 1 to 5, etc. Right? The larger, the better. If you can get a larger risk to reward ratio, it's much better. Much, much better. Right? So that's what it is. That's what we call risk to reward ratio. Always think that, oh, yes, on this trade, I have to make more than I am staking. Whatever I'm staking on this trade, I have to make more. Whatever I'm staking on this trade, I have to make more. Whatever I'm staking on this trade, I have to make more. I cannot be making less than what I'm putting into a trade. It doesn't work that way. If you do that, it's just a matter of time, you will lose. It's just a matter of time, you will lose. Right? It's a matter of time, you will lose. So you don't want to be on the losing side, you want to be on the winning side. So you use the right risk to reward ratio. Then the next thing is lot size. Lot size. So your lot size is still called volume. So volume is how much of this trade are you taking? This is based on the capital you have. So when you think about volume now, think about you are a distributor for Coca-Cola, for example. You are a distributor for Coca-Cola. And then you are doing two people are distributors. They are both distributors for Coca-Cola. One does a volume of 10 million naira a month, and the other one does a volume of 100 million naira a month. So the reason why one does 10 million is because of his capacity. And capacity can mean a lot of things, maybe distribution capacity, ability to sell the products, or the capital you have. All of those things is capacity. Okay. Now, when it comes to the guy with 100 million, same thing. It means he can distribute more. It means he has more capital. It means he has more staff. He has more capacity than the one that has 10 that does 10 million. So that's what lot size is all about, and that's what volume is all about. So if you have $100 in your account, your lot size should be 0.01. That's what it should be. So if you have $1,000 in your account, $1,000, your lot size should be 0.1. 0.1. And if you have, let's say you have 10,000 in your account, 10,000, your lot size should be 1.0. 1.0. So in this case now, it means that in the first case, it means that your lot size, your 0.01 gives you 10 cents. 10 cents for every time price moves. For every time price moves, you get 10 cents. 10 cents, that's what it means. Every time price moves, you get 10 cents. For the one with 0.1, it means that every time price moves, you make, if you're using 0.1, every time price moves, you are making $1. For every time price moves, you are using 0.1. Then, if you are using 1.0, you are making $10 every time price moves. Once you enter a trade, once price moves by only one tick, you make $10 if you are using one lot size. You can see it depends on the capital you have. So this is very, very important, right? That you understand how this is done and what capital you have and how much you are risking, how much you're using for this particular trade, right? So that's the thing. And then the last thing is when you want to determine the exact lot size as compared to your risk per trade. Now, when we're tying this all together, for you to determine your risk per trade, remember we said your risk per trade is 2 to 3% of your capital, right? 2 to 3% of your capital. Now, you know that when you are in the market, you are entering a trade, let's say Euro USD trade, you are entering a trade for a buy, and you are using a lot size. Remember, this is the lot size you're using. You're using either of these, depending on your capital. You're using either of these three, depending on your capital. But how do you then make sure that you are actually factored in correctly the risk per trade, which is 2 to 3%. You have $1,000 now, and you want to risk only $3. How do you make that happen? In the chart, since there's no place for you to actually place $30 as your risk, you can't place $30 as your risk on the chart in the market using MT4 or using the app. You can't do that. You can only use lot size to manage it. So here's the formula that you use. The formula is lot size equals, remember, lot size equals your risk per trade. Your risk per trade, in this case, let's say 2% or let's say 3%, your risk per trade divided by your stop loss. Stop loss. So your lot size is risk per trade divided by stop loss. So let's look at something. We took an example here and we said, okay, look at the stop loss is 200 points, right? 200 points. So let's use that as an example here now. So lot size now, let's say we have $1,000 right now. Now, I know that I have said that if you have $1,000, you can use 0.1, but there are times where there may be a disparity in this. There might be sometimes where your stop loss can be large. If your stop loss is large, this 0.1 may change. It may actually be less than that. In some cases, this 0.1, it can be more. It can be more than that. But then what is important is your risk per trade and this calculation I'm doing for you right now. So your lot size, basically you need to always calculate it, but there's an app to do this on your phone. This app is called the Forex Calculator. Okay, I will do a video on that also and post it in the group so that we can learn to use that. So in this case now, we are looking for lot size. So what we do is 3%. 3% on this on $1,000 is $30, right? $30 divided by 200 points. 200 points for stop loss. Okay, how much is that? Let's see what that is. So $30 divided by 200 points. 30 divided by 200 points, that's 0.15. So your lot size equals 0.15 for this particular trade. But let's say, for example, that you are only risking, you are risking 3%. So, but let's say in this case, you are not risking 3%, you want to risk just 2%. And 2% is $20, right? 2% is 20, 2% is equal to $20. $20. So now to get lot size on this one, what do? We say lot size equals 2%, which is our risk per trade, 2% divided by 200 points. Remember, our stop loss is 200 points. And this one will give you lot size equal to what? 0.1. So you see, it can change. Your lot size can change depending on, number one. So what affects your lot size is, number one, what affects your lot size is your stop loss points, stop loss value, and your risk per trade. Number two, risk per trade. So those are the two factors that affect your lot size, your stop loss and your risk per trade. Those are the two things that affect your lot size. So your lot size, you can see, based on this calculation we did here right now, your lot size can change. Your lot size can change, but then it only changes. Your lot size can change, but then it only changes. It changes, but it's affected by your stop loss value. Let me make this clearer. Your stop loss value, and your risk per trade. Those are the two things that make it, that determines your lot size, right? So even though I said that your lot size, if you have $1,000, use 0.1, you can see that it can actually be flexible. It can actually change. Right? It can go up a little bit. It can go down a little bit. If I had more time right now, I would have done several other examples. But you can go ahead and do several examples yourself, right? You can go ahead and do several examples yourself, right? So that's for that. So we'll put a pause here right now. Let's go into the market and see if we can have something to